One of the clearest trends within crypto over the past, I don't know, year or so is the appearance and increasing popularity of margin trading and different margin trading sites. And I'm sure you've heard of many of them, and many of the different exchanges in crypto now are also adopting this trend and letting their users trade on margin, or using leverage as it's maybe more known. And I thought I would take this video to go through what margin is, how it works actually under the hood, and really to clarify for all of you out there so that you don't use these sites, or that you don't make mistakes with these sites, because the consequences can be quite dire when you're using leverage trading. So I thought I would go through what margin is and how it works so that all of you can use these sites as a complement to your regular cryptocurrency trading or investing. But before we do that, I just want to hear what you think about this new set that I put together. I find it quite cozy. I got some books, I got some sort of statue here. It's a bit more cozy than the black hole, so we'll see what type of videos I can record. It's hard to do, programming videos here because I'm sitting in this chair, but just me talking like this is very cozy, so we'll see. Let me know if you like it. And before I get into the explanation of how margin trading works and what it is, if you're already familiar and you understand the risks and you're aware of them, and you want to get started with maybe shorting Bitcoin because you feel like, hey, we're going to go down, so I want to short Bitcoin, or you want to go long with leverage, then use my link below and go to Bybit and get started today. They will offer you a $60 bonus if you deposit more than 0.2 Bitcoin, so make sure to go there and claim that bonus only using my link below. Let's get into what margin actually is. And when you're trading on margin, you are combining the funds that you have on an exchange and borrowing additional funds from the broker or the exchange that you are on in order to trade and buy assets with borrowed money. And that means that you can get a leverage in your actual trade or investment. So let's take an example, right? You want to buy Bitcoin, let's say, and you have on your account $1,000 to buy Bitcoin with, but you want to get even more exposure to Bitcoin than your $1,000. Well, then if you're on a margin trading platform, then you could borrow, let's say you borrow $9,000, so that you now, in total, you have your $1,000 plus an additional $9,000 that you borrow from the exchange or broker, and in total then you have $10,000 to buy Bitcoin with. And that sounds great, of course, because now you get a much larger exposure to the underlying asset that you are going to purchase. And with that ratio, you have a 10x leverage. That means that whatever your own capital is, in this case $1,000, the actual exposure that you have into Bitcoin would be 10x of your initial investment into that trade. So you would buy Bitcoin for $10,000, but your own capital is only $1,000. And that might not sound too complex. That makes sense, right? The hard thing to understand is how this actually affects your trading position. What type of effect does this borrowed money provide to your trade? Well, if Bitcoin moves $10 in the price while you have bought it, if you're on 10x leverage, you've borrowed $9,000, that would be equal to a $100 move if you just had invested your initial capital. So in whatever direction Bitcoin moves in that case, you would be getting 10 times the effect. And that is of course fantastic if the price goes in the right direction, but investing and trading is hard, so in many times the trade goes in the wrong direction. It goes down if you bought Bitcoin. And then that effect is also multiplied by a multiplier of 10 since you're using borrowed money. It's very important to understand the downside risk, especially when you are margin trading or trading with leverage, because the risks, once again, the risk dynamics change when you have such a high leverage on your trade. And what type of effect this gives to your trade is that if the trade goes in the wrong direction, you will be liquidated. And that means basically that your trade, if the price goes down enough, that your position will be entirely canceled for you without your, approval by, clicking any sort of button, without you actually closing the trade yourself. It will be automatically closed for you. It will be liquidated. And that is because the exchange, they have your account as a security, as an actual collateral. So they will never take any risk. You, of course, take all the risk. And that means that when the price goes down far enough, the exchange needs to make sure that you will be able to pay them back for the loan, and that is why they eventually will close your position and sell those assets in order for them to get their borrowed money back. So let's take an example to understand the downside risks better. Let's say you take on a huge leverage trade of 10x. So you have your $1,000 and you have borrowed $9,000 from your broker, from the exchange that you're trading on. And you're buying Bitcoin at the price of $10,000 per Bitcoin. So you're using this $10,000, you bought one Bitcoin at $10,000. Now, let's say you're in bad luck, the price goes against you, it goes down, and it is starting to approach $9,000 per Bitcoin. Now, this is a simplified example, but at that point, the only assets that you have in your account is the actual Bitcoin that you bought. You used all of your money in your account to buy Bitcoin, and now the Bitcoin price is approaching $9,000. And remember, you have a loan that you took out from the broker of $9,000. If the broker want to get paid back, which they do, they now need to liquidate your trade in order for them to be sure that they get their $9,000 back. So at around $9,000, this will depend on the broker or such, they will close down your position and sell your Bitcoin, get those $9,000 back and pay themselves back. And whatever is left, you might get, that part. So let's say they liquidate you at 9,000. Well, then they would sell your Bitcoin, get the 9,000. They would take that because that is their loan that they gave to you, and you would be left with zero. Even though the investment just went down $1,000, which is maybe something that you expect in Bitcoin, if you didn't analyze the risk, you wouldn't understand that you would get liquidated at 9,000, because that is when you actually ran out of money. And usually the exchange will liquidate you earlier than that because they want to be on the safe side. They don't want to liquidate you on a hair-thin margin. Another thing that's important to keep in mind when you're trading on leverage or on margin that you need to know is that whenever you borrow money, in any case, you probably already know that you would have to pay interest on that loan. And the same thing is true in leverage trading. You have to pay interest. And that interest, depending on your broker, is calculated differently. Sometimes it is interest-free if you're just taking day trades, meaning you're only trading during the day. You're not holding any positions overnight. But many of the sites out there have different fee setups where you might have a commission whenever you trade, or you might have an interest rate that will be taken from your position over time, or you might be charged only when you keep your position overnight. But it doesn't matter. I can't tell you exactly, of course, because it depends on your broker. But one thing is sure, and that is that they borrow you money, they want interest. So you need to check what sort of fee and interest structure your broker has before you start trading on leverage, because otherwise you might end up sitting on a position over a long period of time and being charged a lot in interest. So make sure that you know what your broker is charging. The other question that might arise in some people's head is, so where does all of this money come from? If I go 100x on whatever site out there to buy Bitcoin, where does all of this money go? Or where does all of this money come from? Because that's a lot of money. If I invest $1,000, then all of a sudden I can 100x that. Where does all of the other money come from? Well, that can be different depending on where you're trading. Sometimes the actual broker will supply that money. They will provide you with the loan. And sometimes it might be other investors on that platform. So it would be more of a peer-to-peer like structure where you have both lenders and borrowers on one of these sites, where the lenders can give you money for your leverage trade. And now you might say, Philip, this sounds very scary. I don't want to take these huge risks, leverage trading 100x, 10x. Well, then you probably shouldn't, right? You need to be an experienced trader whenever you trade with leverage, or you need to start out small. I mean, you can start with 2x leverage, which is for many people in crypto good enough. You don't need more leverage than that in many cases. But it's funny because many people are already familiar with leverage, but they don't think about it, because almost everyone buys their house on leverage. They buy it with borrowed money. So you have an initial investment into your house, that's your own money. And let's say you buy a house for, I don't know, $100,000. Then you might provide $20,000 in down payment, which is your own money. But the rest, you will be borrowing from the bank. And guess what you're doing? You're doing a margin investment, or an investment with actual leverage, because you pay $20,000 yourself and then you borrow the rest of the $80,000. So that is an investment with a 5x leverage. And that is why if you're actually buying houses and you witness the prices in the housing market going up, that return for you can actually be very, very good, because you are doing a leveraged investment. And that also shows up when people lose their homes, right? When they lose their home because they can't make the payments, they will get liquidated. And many people, of course, got to know this in the housing crisis, unfortunately. And then the bank has the house as a collateral. Instead of in a broker account, they have your account and the funds that you have in your account as collateral. So it's very similar in many ways, only that, of course, a house payment is a way more secure purchase than Bitcoin. It's less volatile. So the collateral is a more stable and long-term collateral, while a Bitcoin trade would be a short-term trade where you have a very volatile collateral. And that means that you probably should be very careful with your actual margin or leverage that you're using. Now, if you're watching this video and you know about the risks, you know about how leverage and margin trading works, and you want to get started, then you can use my link below on Bybit, and then you will get $60 as a trading bonus when you sign up. So if you use my link, you get that $60 bonus. If you deposit more than 0.2 Bitcoin, then you get that $60 bonus. So make sure to check out that link below if you want to start trading on margin, if you want to do leverage trading, or you want to short Bitcoin, then this is also a great site to do that on. And if you want to get that bonus, as I said, make sure to click my link below and get started today. Thank you so much for watching. Now, if you have any questions or you have any thoughts about margin trading, make sure to leave them down below. I'll be happy to discuss with you there. Are you using any of these platforms to go long or to short Bitcoin or other cryptos perhaps? Let me know below. And if you enjoyed this video, make sure to hit the like button. Otherwise, you can hit the dislike button. But either way, get subscribed to the channel so that you don't miss any of my future videos. Hit that bell button so that you get notified whenever I upload. With that being said, thank you so much for watching, and I'll see you in the next video.